Alrighty, folks, we have the one and only Mr. Dan Bird, who does his best to keep us up to date what the market is doing, what the internals and charts look like. And Dan, first thing I want to tell you, actually, I texted you Thursday morning. I sold out of all my positions that I collected over the last 6 or 9 months. So Meta's gone, Blackstone's gone, JP Morgan's gone. I chose to get flat. Go to
All with
zero.
gains, right?
All with gains. Everything made some money. So I don't know how to act. I actually made money trading stocks. It's kind of weird. But yeah, I don't
That's
own any
good. So
stocks as of this
so
moment.
when I got that text from you, I loaded up. I maxed out my account because I knew for sure the market was ready to take off.
Yeah, you're probably right. Exactly. I am the harbinger of do the exact opposite. Yeah. But yeah, I just thought it was important for me to stay intellectually honest with the audience. I told them when I bought them. This is my first video I've done since then. So yeah. And really why, as you said, as I told you in the text, the reason I got out is I looked at what's going on in the economy and I saw limited upside and a whole lot of downside. So I'm like, hey, take my chips off the table. You know, doubled my money in one of those trades and made money in the other two. So I'm like, I'm out. So where are we at in the
So
stock
yeah,
market?
that's not a bad decision
Yeah,
for a
I feel
for
good
a
about it.
for a trader.
Fair enough. Touche. Touche. I do try to call myself an investor. But yeah, I mean, when I look at this, what's going on in my macro view, and again, I understand that macro view and the stock market sometimes are not connected, but that's where my head is. And
Right.
I'm like, I see storm clouds. I don't even see storm clouds in the horizon. I see storm clouds like next door. So I'm like, all right, if that's really what I believe, then time to leave.
Yeah, I mean it's probably not a bad decision. I full disclosure, I'm flat as well, but mine kind of corrected on its own. So I moved all my stops up. I didn't actually sell stuff. I just moved my stops up and they all stopped out with gains. So I'm naturally flat.
Very
Um,
cool.
the market kind of took me out.
Okay.
So
Yeah. So let's talk about where we're at with the market, what we're set up for next week. We got a lot of important earnings. We got a lot of economic data. We got the last inflation reading on Friday, the PCE, excuse me,
and GDP next week too.
and GDP, first cut Q1 GDP. I think it's expected to be 2% after Q4 is 2.6.
Yeah.
Yeah. Lots of important stuff. What do you got? What do you got for us today?
All right. So I know we've got limited time, so we'll be pretty quick on some of the stuff. Um, I did not do before I share, I did not do a midweek update because I had surgery. I don't know if you can tell right
Oh
here.
no. Oh no, can't tell. Oh yeah, I can see it now. Yeah.
Yeah.
All right.
So just a little PSA, use sunscreen
Ah, yes, use sunscreen. Yes, exactly.
and get checked every year. Very important. So I had a little basal cell,
Okay.
which is the least dangerous.
Okay. All right. Well, I'm glad you're good.
Anyway, Wednesday, my nose was completely covered with bandages, so I didn't do it.
Yeah, it would
Maybe,
have been a bad look. Oh, the
right.
market took him. The market really wrecked him.
Yeah,
Oh, it's funny.
the market took me down.
That's
All
right.
right,
That's right.
so here's last week and next week. It's kind of quiet as far as economic calendar goes. We didn't have a
Yeah.
lot. Jobless claims came in worse than expected. Manufacturing was much worse than expected.
Yeah. The Philly Fed. Oh, that was
Yeah,
ugly.
right. Um, but services came in stronger,
Yeah. Yep.
which most of our economy is services oriented anyway. And then next week we have durable goods. GDP is on Thursday, expected to come in at 2%, and PCE, which is what the Fed looks at, April 28th.
Yeah. That.
The expectation is for it to be flat.
Mm-hmm.
I would not be surprised if it goes down slightly.
Okay.
It looks a little bit better.
Yeah, that'll be the
However,
last inflation reading before the May 2nd, May 3rd meeting. So it's an important one.
yes, the last one before May 3rd. And then here's what worries me, and one of the reasons why being flat might be a good idea. The May CPI number.
Yes. Mm-hmm.
So you can see this is the one that dropped off the last time where we had a big 1% drop in
Yep.
CPI.
Yep.
The next one that drops off is very small.
Yes.
So that's not going to be good. Now the two after that are huge.
Yeah.
So I think what's going to happen is we're going to have a bad CPI number.
I agree.
And then we're going to have two huge ones that make it look like it's literally falling off a cliff. We could get back down to 4 or less by the end of July or August.
It's funny you bring this chart up because this is what I think I called it the day after the CPI reading said 5. I'm like, folks, I think the trend breaks next month and we go higher, right?
Yeah.
I think we've been 9 months lower on headline CPI. I think next month goes higher because of this exact reason. I don't think a lot of people understand. It's going to shock people.
That and this.
Yes, exactly. Commodities are not helping.
Commodities are screaming higher. Now that they've rolled over a little bit in the last week or so. So we'll see if that continues. But this shaded area is what the next report will be. The next CPI report will entail the shaded area and mostly the beginning of this month.
Well, yeah, so this big, all the bad part.
Yep. This big ramp higher. In fact, if you look at from last month, the middle of the month was a huge drop.
Yep.
Which what helped us, lose that 1%. But from the middle of the month on to the middle of this month, it's a huge gap up. Yeah. And that's going to be reflected in the next CPI number.
Yeah, folks, we're going higher is my prediction, my guess.
Yeah, that's right. So that combined with this, I think it's going to look really ugly. I think the whole market probably will sell off, which is why it's probably good to be flat right now.
Yep.
We might still have a sideways trending market. So this is the S&P right now. And what I said in the newsletter, in fact, let me show my newsletter if any. I don't think there's a lot of people that aren't on my newsletter now.
Yeah, you're pretty they like what you do for us.
Yeah, I'm not getting a lot of requests. I get a few after our Sunday calls, but nothing like in the beginning. So I think it's probably pretty much full. Okay. But this is a newsletter I do for free. There's no charge. I don't sell your email or any of that. You won't get spam. I just do it for myself and friends and family, and I send it out to folks on your channel. So if you're interested, send a note to breakpointtrading@gmail.com, and I'll add you to the list. And I put these little cartoons in right here. I was at dinner with some friends last night, and they're like, "Oh, I loved your cartoon about the Alexa, the lady talking to Alexa." That's the one in the upper left.
Yeah, the Kleenex. I saw that.
I said, "Yeah, did you read the newsletter?" No, I just want to see the cartoons.
Yeah. There you go.
That's pretty funny. So here's where we are for the month. We've just had options expiration on Friday. Options expiration week, like I've said many times, is usually the opposite of what the market has typically been doing in the past. So the market had been rising, so I expected it to decline last week. And it sort of did, but not significantly. And just out of curiosity, I wanted to go look at Tom Bowley's Max Payne analysis. I talked about this last month and decided that it didn't really make a lot of sense to use this as an indicator. So I just, out of curiosity, wanted to go back and see what Max Payne looked like after options. So Max Payne indicated that the S&P would be at 401. It was at 412, which is exactly where it was the week before. And the Qs, which is the NASDAQ, Max Payne said it would be at 306. It was at 317, almost exactly where it was a week earlier.
Right. Okay.
And these are the other major ones down here. The only two that, Tesla came in lower than Max Payne, AMD came in lower than Max Payne.
Okay.
Black ones are basically even, and the green ones came in higher than what Max Payne said. So I'm not sure Max Payne is really that helpful, frankly. Okay. It's interesting,
right?
But I'm not sure it's all that helpful.
I think we've looked at it a couple of months in a row now, and it's not a it's an interesting intellectual exercise, but not meaningful.
That's right.
Yeah,
that's right. Not something I would make a trading decision on.
Not at all.
So going back to where we are. So I mentioned this in the newsletter as well. This is the range that the S&P has been in since basically the beginning of the year.
Yeah.
It goes down, it goes up, it goes down, it goes up, it's starting to go down. You know, will we go back down to the bottom of this range again? Who knows? But we are definitely range bound.
Mm-hmm.
There are certain ways to trade this, so some certain advanced options ways to trade this and make a lot of money in sideways markets, which I'm not going to get into today, but it's kind of difficult to, you know, trade this unless you just sell at the top and buy at the bottom.
Mm-hmm.
Right? Which is why mine basically all stopped out, because I moved all of my I bought down in here.
Mm-hmm.
I had trailing stops. So as my stocks went up, I moved the stops up. And then as we hit this top level right here, I moved them up to really tight stops.
Right.
Because just like you, I was kind of thinking the market was about to head lower.
Right.
So it just basically took me out of everything.
Yeah. So
Just
what position, what were you in? Were you in the like Nvidias of the world, or what were you in before you got
I
stopped out?
had some AMD. I had some Amazon, which actually Amazon we'll look at Amazon in the next session that we do.
Okay.
So I want to talk about the earnings next week
Right.
in the next session.
Okay.
A few things like that. A little mixture,
Just
actually.
curious.
I had some energy stocks.
Mm-hmm.
So now, while the market did go down slightly, you notice it still didn't get back to the 21-day moving average, the blue line.
Mm-hmm.
That line essentially is the reversion to the mean. So because it's still above that, it actually means the market is still hanging in there, even though it's declining last week.
Yep.
But I kind of attribute this to options expiration week.
Okay.
But the last 2 days, the market really hasn't done much of anything.
Mm.
You can see on Thursday it went up, it went down, and it ended right exactly in the middle.
Mm.
And on Friday it went down, but it didn't go down as far as it did Thursday. And it came back and ended pretty much exactly where it started.
Yeah.
So it really hasn't been doing much of anything. It's just been sitting there waiting for something to happen.
All right.
Now,
Okay.
that something to happen could be the CPI number in May.
Yeah, it could be.
So we'll
Okay.
see. This is the long-term view. And I had said this before, this shaded area that I created here,
Mm-hmm.
a lot of congestion in that area. So I expected, and I said this a few weeks ago, I said, I expect when we get above 4,100 that we're going to run into a lot of shorts, a lot of bears that are convinced the market is going back down to the lows again. And it's going to have a really hard time pushing through this. So it's a battleground. This is a battleground right now.
Right.
And we don't know who's going to win. Is it the bears or the bulls? If the bulls can push it above 4,200, that will be positive, but it really needs to get above 4,300 to really take off.
Okay.
But there's going to be a lot of people short in here too. They're convinced that, especially at this 23% Fibonacci level, which is right at 4,200,
Mm-hmm.
you know, if we go up, if we can rally a little bit next week and hit that, by the time we get to May 14th, so basically 3 more weeks, it's right out about in here. If we do rally up into this 4,300, and then we get that bad CPI number, that's going to be, you know, all the bears are just going to pile in, and this thing is just going to go down again.
Right.
So, like I said, there's a lot of congestion here. There's a lot of risk in here, which is really what charting is all about. Try to identify where the risk is. Risk management is really the key in the stock market.
Yeah.
So we're at that point right now, and the market's struggling. It actually feels to me like it's kind of exhausted, just kind of tired of going up. It wants to either roll over or just go sideways and do nothing for a while.
Yeah.
Which I think it actually might just do nothing until that CPI number. But the VIX looks fantastic.
Yeah. It's a teenager.
Yeah. Yeah. I mean, it was closed at under 17. No, at 1770. It was under 17, but it closed at 1770. I'm sorry, it closed at 1677. So it closed under 17 on Friday. Yeah. And still heading down.
Doing nothing.
So even though that means there's very little fear in the market right now. So the
Is it?
market really is.
That's the low of the year, or what?
Yeah. Oh
Or
yeah.
whenever
So
this
it's the low. It's probably the low of
multiple years.
about two years and see where, not quite 2 years. So back here in 21, this is the 21 period where the market was just screaming higher.
Yeah.
And you
Okay.
can see it was lower. It was down around 16 and even 15 something back in
Okay.
here.
Yeah.
But
All right.
it's still in that neighborhood,
Yeah.
still generally in that neighborhood. But even with the VIX being that low, the market isn't really doing anything.
No, exactly.
The market's going side, the S&P's going sideways, trying to get through this 4,200 level. Put call ratio is heading down, which means again fears coming out. People aren't buying puts; they're buying calls. Number of stocks above their 50-day is just kind of going sideways. The 10-year Treasury is going sideways. Everything is just sort of treading water right now. And then we looked at this one already for the commodities, which is why I think we'll have a bad CPI number. Yeah. And then this one is interesting here. I decided to go back 2.5 years essentially, and where I have those circles. So this is where we ended. This is a weekly chart. Mm-hmm. This is where we ended on Friday. Basically, just before May. Just before May a year ago, this is where we ended.
Oh wow!
And just
we ain't
before
done anything
May,
in 2 years.
Just before May 2 years ago, this is where we ended.
Wow!
So if you had got into the market 2 years ago, you would be flat right now. You would have been on a roller coaster ride.
Yeah.
But if you just bought at this point and held on, you would not have made any money at all.
Well, there are some people calling for a lost decade. I'm sure you've heard that.
Yeah, I mean that's very possible. That's that would be interesting, but that's very possible. I think it might actually happen that we just start trending between these two levels. Between this 48, let's call it 47, 46, 4,700 and the 3,800 level down here. That the market just bounces along for years. It could easily do that for years. Just bounce sideways. Now, if that happened, there's some ways you can make a ton of money in a market like that. You could do iron butterflies.
We don't need to get into anything sophisticated on this show.
Yeah, that just means it's an option strategy where you anchor the top and the bottom, and as long as it stays in the middle between those two, you make money.
Got it. Well,
and you just keep doing that over and over again. As long as it stays in the middle, you just keep making money over and over again.
Yeah. There you go.
So there are ways to make money in any market.
Sure, of course.
Basically. So that's where we're at. I mean, that's all I had, except for we're a short time, and I do want to talk about the earnings in the next session. So
we'll do that.
But one thing that I want to show, and this came from a comment from last week on your YouTube channel. Somebody said the market has never hit a bottom before a recession.
Okay.
Market always hits a bottom during or after the recession.
Okay.
And I certainly think that's probably true. That doesn't mean we're going to have a recession.
Right.
We could get through all of this. The market could just go sideways and we don't have a recession.
Yeah, I think one of the things we talked about on this channel months ago was something that now people are calling a rolling recession.
Yeah, I actually put that in my newsletter too.
Yeah.
People are actually talking about. We talked about that here 2 or 3 weeks ago.
Yeah.
A month ago. Right.
Yeah. I think a rolling recession, if I had to, best guess it, is probably the right answer, right? We've already seen housing into a recession or depression. It's now bottoming. Right. We're seeing retail come in. We
saw negative GDP. We saw retail starting to drop, but retail's starting to come back again, interestingly. Yeah. Now will we now have an earnings recession? We're going to find out next week, next 2 weeks.
That's right. Yeah, we're going to find out.
We'll talk about that in the next session.
Okay.
And I'll show Netflix and Tesla from last week. But I thought I'd go back and take a look at the last 100 years and see what happened during a recession and where the bottoms actually came in. Now, keep in mind, with my thesis of bull and bear market, secular bull, secular bears, right? because that's important to understand as well. You just can't go back and say, all these recessions, the market hit the bottom during the recession.
Mm-hmm.
Yeah, but was it a secular bull or was it a secular bear?
Right.
They always have to keep that in mind. So I drew these boxes around these different levels. This goes all the way back to 1900.
Yeah.
Yeah.
Pretty cool.
This goes way back. So the gray areas are recessions.
Yep.
And the green boxes are what I drew in for the secular bulls and secular bears. Okay. So if we look at the COVID recession, and by the way, the idea of a rolling recession, probably nobody that's in the market today or anyone that's under 40 probably have not seen a rolling recession.
Correct.
The last three recessions we had were all at once recessions.
Correct. Yeah, Liz Saunders is starting to talk about this, yes.
Right. COVID was all at once. The financial crisis was all at once. The dot-com bust was all at once. Those are all at once recessions.
Correct.
This one will not be like any of those.
I agree.
So here's COVID. Yep, hit the bottom during the recession. Here's the financial crisis. Yep, hit bottom during the recession. Here's the dot-com, actually hit bottom after the recession. Now this one here in 86, 88. This is the 87 crash right here. Actually, that's not a recession. The 87 crash was not during a recession. The recession actually came in early 90. So it depends on how you want to interpret this. Sure. So the bottom was right here during the 87 crash. But remember, this is during a secular bull market. So look at this 87 crash, similar to the COVID crash, which is also in a secular bull market. So we did have a recession, and we could certainly have a recession now, but it was because it's in a secular bull, it was short and shallow. And if you want to call that the bottom rather than this the bottom, then yeah, you could say the bottom was during the recession. But I would say the bottom was actually before the recession. And this was just a sideways movement that happened to coincide with the recession.
The thing I take away from this chart, is we used to have a lot more recessions. They used to be a lot more frequent.
Yeah. Well, so that's an interesting comment. So think about that within the context of my thesis of secular bull and secular bear. All right. So look at the green box. There's only one. Look at this green box. There's only one. Look at this green box. There's two, but short ones and very shallow ones. Right. And now look at the red boxes. Two, and this one here was a wide one. Look at this one. 1, 2, 3, 4. All within a secular bear market. Yep. This is the 1929 crash. 1, 2, 3, 4, 5. Yeah. All within a secular bear market. This was 25-year secular bear market. All right. So yes, that's a good observation, but it reinforces my thesis of secular markets. Right? So always keep that in mind. Whenever you hear people saying things and putting up charts and saying, oh, well, this recession was this bad. So the recession's back here, and in the financial crisis and the dot-com crash, there were bad recessions and the market dropped 50%. Yeah. And the first thing I think
talk about a lost decade. I mean, just looking at this simple chart.
Yeah, right there.
From the beginning to the end, that's a lost decade right there.
Right. That's right. But I always think to myself, well, was that a secular bear market or a secular bull market?
Got it.
And I know now when those are. So I knew that this was a secular bear market. That's a very different scenario than being in a secular bull.
Okay.
All right. So the comment was not incorrect. Right. The market does not bottom before a recession. It usually bottoms during or slightly after the recession. That's true.
Okay. Very cool.
But it doesn't mean
I like data.
Except for this one, during the 80s, where I would say it actually bottomed in the 87 crash, but it didn't even go into a recession until early 90s.
Yeah, the 87 crash, I don't think was an economic event, which I consider recessions. I think it was more of a trading and leverage problem.
No, that's absolutely correct. And the COVID crash was not an economic event either,
Correct. It was, yeah, correct. Okay, cool. Yeah.
right? But it still had a recession.
Oh, absolutely. No
So
question.
I think what we're going through right now is more similar. And I showed this before on this channel. I showed the two of them, and I said, don't they look the same? Don't the 87 crash and the COVID crash, don't they look the same?
I remember.
Let's see what happened after the 87 crash and look at the market took off.
How long did it take to get back to the peak though? So 87, what you call
To
that?
2000, basically.
No. Just to the 87 peak.
Oh, back to
So,
here, it took,
yeah.
so this is 90. So it took
Call it
3 years.
2 years. Yeah. Okay.
2.5, 3 years. Yeah.
Okay. I was just curious. All right.
And we are, we're almost a year and a half into this one right now.
Right. Okay.
So yeah, we could easily go sideways for the next year or 2 years.
Right.
In the market.
Very cool.
But
Well, let's get into topic number 2. Dan, do me a favor one more time. Show the email if somebody wanted to get added to this amazing newsletter.
Yeah, hang on. Oops. Send me a note to breakpointtrading@gmail.com, and I'll send you last week's newsletter and add you to the list.
Very cool. Thank you so much.
If you ever want to get taken off, just let me know. It's not a big deal. It's pretty easy to do. So
yeah. Thanks, buddy.
All right. Take care.